Inflation, what is it? Why should you care? How does it affect your portfolio?
It affects us.
It affects us deeply, touches us, and deep inside.
What? No. Inflation is when the products and services get more expensive on a regular basis. Now, that's not necessarily bad.
Basically, inflation is a indicator of cost in goods. As services go up, the profit margin of the company, if inflation is healthy, will lead to higher stock prices and higher good prices so that they're making more money. And that's a good thing. In hyperinflation periods where it goes way up, then it's pretty bad because people aren't going to be able to afford the goods because it's going to be way overpriced. Their salary is not going up so that they're not making any more money to buy those higher priced products, and just cost of living is outrageous.
Brian's explanation, pretty close, pretty dead on. Right now, the Fed is raising rates because of what Brian talked about, hyperinflation. Hyperinflation is a problem. If you are a business and you have, let's say you're a landscaping company, you got a bunch of trucks and you're trying to get a loan. And you got a loan before this, and the Fed raised all the rates. It was at 2.75%. They're super low rates. Well, now you have the same amount of income that you had before, maybe just a little bit more, maybe 1 or 2% more, and you need to replace those vehicles. You need new trucks. Well, now your rate is 7%. So if you were paying $1,000 a month in interest, you're going to pay 3 times that now because the rate has gone up so high. How does that affect your stock? Well, if you are that same company and you're a publicly traded company and you need capital to get things, that's the loan. That affects their ability to make money. So if they make less money, then therefore the stock price has a problem. The stock market is crashing this year.
Right.
A lot. More than it has. It's actually one of the top crashes in history.
Price of goods and services has gone up. People aren't making any more money to buy those. There's supplier issues with COVID, which is a double whammy. That's affecting the company's ability to make these products. So the perception of these companies is low, that they can't pay their bills because they're not making enough profit. And as we all know, stock market is all about companies making profit. What have you done for me this quarter?
Right.
Make more money next quarter. Always make more money. So if they're not doing that, people aren't buying the stocks are going to go down, and they're selling. They're going to sell.
We actually talked about that. We have a portfolio. We started over for everybody watching. Thank you. We've got 7 months of investments at $400 a month, and we've got this portfolio built up to build up passive income. And twice along the journey of that, because this is a bad year for stocks, we've actually run into 2 companies that had a problem because of this inflationary issue. Campbell Soup was one of them, and Ford was another one. The chip shortage affected Ford. They couldn't get chips. Well, they couldn't produce. Because they couldn't produce, they had a whole fleet of vehicles that they couldn't sell. Profit goes down. The same thing affected Campbell Soup. They're a food company that we wanted to buy them because it's a relatively stable company. Normally, it's a pretty good buy. This time around, though, they couldn't get the product to produce their cans.
Yeah. Aluminum was unfortunately not being mined.
and they couldn't make money from that, so their profit was affected. So we go back to our $2,800 that we've invested as dividend dudes, and let's take a look at the portfolio. Right now, that dividend portfolio is $2,900. So we've made money in the history of one of the worst stock market crashes ever.
That's beating the market, as far as I see.
It's beating the market, and that's not including dividends. So if you look at the rate of inflation, it's 8.3, 8.6%. The Fed is trying to fix that. And if we go back to my other example with the landscaping company, and you're the landscaping company that needs to get the trucks, but let's say their previous loan, I'll circle back. So you look at this, the previous loan was at 2.75%. If you're a bank and you're lending somebody something at 2.75%, but inflation is at 8.3%, okay? You're losing money as a bank. You're not making money. you've lost money just because the cost of your being able to just buy stuff is not keeping pace with the ability that you're making on your money. There's all this negative pressure. To bring this back to dividend dudes, if we bring this back to dividend dudes in the portfolio that we have, if you take the money that we've gained in the portfolio itself and you take our dividend checks, we're keeping pace. This is why we talk about making sure that your stocks that you buy can afford things like the dividend that they pay.
Exactly. And you do that by going into their balance sheet, going into their income statement, the cash flow statement, use the PE ratio, look at their EPS, all these things that are there to tell whether your company is going to weather the storm of the worst recessionary period that we've ever been into. And if you've done that, like we have with the stocks that we purchased, you gain $100 instead of losing $400.
You're doing good. In fact, last month, if you follow along to buy the stocks that we've purchased, and you did that, as long as your financial advisor was okay with it, you've made, what, $50? We made $50 last month. That's great. You got a check. So not only did your $2,800 stay safe, while the market's, I mean, it's like a nosedive.
Yeah.
the market,
everything's on sale. It's a fire sale.
It's a fire sale.
But now you have $450 instead of $400 to buy more stocks that are now on sale.
To make more money. So we're doing it. This is real money. And again, we started over. We have our own portfolios, but we started this portfolio over for you. We wanted to create the channel to help somebody figure out, how the heck do I get financially free? How the heck do I do this? It's not easy. Because if you look at some of our previous months, we're going to do it again for next month. We had a spreadsheet out there. We looked at the balance sheet. We looked at all the things and we made a purchase based on that. We don't expect everybody to be able to do those things.
It's a lot of work, but it's worth it.
It's worth it. And you're starting to see the fruits of those labors. Now, the other thing we did in that spreadsheet, we talked about it, but we didn't really touch on it much. And that's kind of what this video is we actually account for the inflation in the income statements of those videos. I asked Brian a question, and the question was, did the company still make money? And inflation played a big part of that. And some of our stock decisions that you see us purchase have a lot to do with whether or not what's happening macroeconomically. This is why you can't just look at the balance sheet numbers. You have to look at what is the Fed doing, what's the company doing, what's their supply chain, what is that doing, what are the customers doing.
Go through the news stories on them from reputable news outlets.
And there's more to it than that. I saw a couple of YouTube channels post about dividends, and they were talking about dividends getting cut. Well, yeah, you didn't.
Because they can't afford it. You didn't do your due diligence, and you didn't do your research to say, okay, if they lose this much money, can they still pay their bills? Can they still afford that dividend? And if the answer is no, you did it wrong.
Right. Now, we're not saying we're perfect. We encourage.
We make mistakes. We get it wrong once in a while. Yeah.
Yeah. We're saying that, look, we've done a pretty good job as far as the portfolio is concerned. And if you've been following along, you've been investing with us, we've been doing really well. We're keeping pace with inflation. We're keeping pace with everything else. You've protected your principal. There's not a lot of people out there this year that can say they've done that.
And we can.
We've got proof. There's proof.
How does inflation affect your portfolio? Well, indirectly. It affects the companies that make the products. It affects the product's price. It affects the employees' ability to purchase these products or even keep their jobs so that they have money coming in to purchase these products, which in fact causes the stockholders to either sell or not purchase and wait.
Inflation is a vicious cycle. Too much of it, and the bank example and the example with the landscaping company, they can affect things. That affects jobs, and you've seen a lot of layoffs. That affects the housing market. I think I saw an article, is 20% of home purchases are falling through in overpriced markets. It affects a lot of things. So we talked a while ago about adjustable rate loans and all that. And if you had one of those last year, you're feeling some pain this year. And the Fed is trying to bring that into a reasonable number so that things don't spiral out of control like Greece or Venezuela or some of the other countries. And there's a lot of speculation. Are they doing really good? Are they overshooting? They're not. I would not want his job right now.
No.
That's a tough job. But as far as our portfolio goes, and as far as how it affects you, the person following along, watching this, and if you've done this, you've done quite well. Be careful with companies that pay high dividends in super inflated environments like this, because it might be a sign that they're not making money. It also might be a sign of the cost of goods and services and even labor. If somebody says, hey, I can't afford to buy this gallon of milk or pay my heating bill, I'm going to go find a new job. They get a new job. Well, if the company is not paying more or charging more for their products and services, they're making less money. As far as investments are concerned, when we buy stocks, you have to keep that into account on their dividend and their income. Again, if a company is making 4% net profit, net revenue, 4%, their dividend is 8%, something has to give. They can't afford it. Maybe not right away, maybe they'll go a year or two that way, maybe they'll go a few months. But when we buy stocks in our portfolio, we're careful about that. And that's reflected. You can see it on the screen, you can see what we've done as far as dividend dudes, but there's more to it. So inflation, as far as it affects the stocks, it does affect them. It affects what we buy and how we buy it. Now, economically, you could talk about jobs getting cut, all that other stuff. But right now, we're building passive income. That's what the portfolio is for. And if you hang on to what we've got, you're still going to get the passive income. These companies are healthy, and you're going to do fine.
If you've gotten this far into the video, go ahead and like and subscribe. And I know you've liked it because you've gotten a long ways.
Thank you.
So go ahead, that helps us with the algorithm. And if you want to learn more about how we pick stocks, go ahead and watch this video.
Yep. Next time around, we're going to be talking about the stock picks that we're looking at, and then probably following that video, we're going to talk about what we purchased for month 8. We're going to grow our dividends. We're going to make it better for everybody.
With you. As always, happy investing.
Happy investing.